Should you be investing in international stocks? And how should you go about if you want to invest? That's what we're going to explore today in our episode. Internationally, there have been great funds, great companies that have raised capital. The Googles of the world, the Facebooks of the world are all out there as listed companies in the US market. And US market accounts for almost 50% of the globe. As Indians, we've always looked at it at far, never really got down to investing. It was not also possible in the good old days, but it's not so anymore. You can take your money and now take that into US dollars up to 250,000 US dollars per person per year. RBI permits you to take it out of the country and invest it abroad. So that's as easy as it gets. However, in the recent budget, Nirmala Sitharaman has made it a 20% tax on any overseas remittance. So which means that if you took a large sum of money, you would also end up paying a large remittance as tax for taking that money out in dollars. So then what's the solution for small and retail investors if they want to take an exposure? And why at all should you take an exposure? Why not you stay with India-based companies? Friends, as portfolio grows, it's extremely important to have a diversification of your assets. So most of your investments, of course, will be in India, in real estate, in stocks, in bonds, and so on and so forth. But a small percentage, we also advise, must be in other assets like overseas international markets, so that if something were to happen here, that investment will be not correlated with this. So to that extent, your overall investment gets diversified. A diversified portfolio is a great risk mitigator, which means that nothing that happens in one place will impact everything else. So this is one of the chief reasons why we believe you and I must invest in international markets. Now, as I said, one route is directly remitting the money. Of course, there is currency conversion costs, there is taxation, all of it. But of course, there's another way, and it's an easier way to do it, which is there are India-based funds which collect money from you in rupee terms and then use that money to invest in overseas. And there are lots of funds which are doing great work in this space. All these funds look at specific segments of the overseas market. So you could either invest in the NASDAQ fund, or you could invest in a global fund, or you could invest in a global consumer trends fund, depending on what you eventually want to kind of look at in terms of your investment. All these are good ideas. Now, why would you want to invest in international funds, especially at this point in time? Now, my thoughts are as follows, friends. First, the global markets have seen a reasonable amount of correction. Over the last, say, 12 months, international markets have corrected somewhere in the region of about 25-30%. Although they have kind of gone back a bit, it still is a significant correction to what they were a year ago. From their all-time highs, they're almost 20-25% lesser. So these are reasonable valuations to get into some of these funds. The way to invest in these funds is through these local India-based mutual funds, as I was telling you. The second reason, India has, on the other hand, been at a reasonable all-time high. Despite high inflation, we have seen a market highs of which is quite unparalleled. So it may be a good idea to take some of that money which is there in India portfolio and invest it into global funds or US-oriented funds, so that you get the arbitrage of trying to play between the India market and the US market. Third, you're going to invest your money in all these international funds. There are two returns that one hopes to make. One is, of course, the portfolio return, which means portfolio will generate 8 to 10% or 12% year on year over long term, and that's the return you will make. The other return also that one hopes to make is the dollar conversion. Remember, you are investing today into that mutual fund in rupees, but that mutual fund in turn is converting that into dollar money at say 82 or 83 rupees per dollar. Now, in the long term, let's say 10 years down, this money, when you kind of get it back, you're getting the portfolio appreciation, but you'll also make the dollar appreciation. As per past, dollar appreciations have been about 4 to 5% year on year, which means over a 10-year period, you will hope to make another 5% on dollar appreciation as well. Put these two together, one can seek to make a decent return of anywhere between 12 and 15% in these international funds. Given that these are large companies with global markets, deep pockets, they are reasonably safe bets as well. So if one were to look at a diversification from their portfolio, no better time than now to look at international funds. Some of the portfolios hold some of the bluest of blue chip companies that one can invest in given the opportunity. So it's not a bad time to take some money out of your India-based equity portfolio and look at global funds.